Welcome back to Alpha Recap, your after-hours quick take on the market's biggest moves. I'm glad you're with us. Markets closed mixed today, and we've got three stories that really set the tone. Johnson & Johnson's big manufacturing bet, a heavy sell-off in the iShares Silver Trust, and a new battery underwriting tool that could speed renewable projects. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. Lots to dig into. Healthcare Capex, retail-driven commodity swings, and infrastructure tech. Good mix.
Let's start with the headline. Johnson & Johnson announced plans to build a cell therapy manufacturing site in Pennsylvania with more than $1 billion in investment. Drew, first reaction?
Big strategic signal. When a large pharmaceutical company puts over $1 billion into a single site, it's saying it plans to be a major manufacturer in cell and gene therapies, not just a small player.
So what really stands out here is the capital commitment and what it means for long-term optionality.
Exactly. There are three practical implications. One, it creates capacity for their own pipeline candidates, which matters if any of those therapies get commercial approval. Two, it's a material capital allocation. Investors will watch timing and cash flow impact closely. And three, a U.S. site can be used for contract manufacturing, which is a revenue stream in itself.
Right. And for income or value-focused investors, a billion-plus project isn't trivial. It changes free cash flow outlooks, at least temporarily.
Watch for construction timelines, staffing announcements, and any contract manufacturing partnerships. Those details tell you how quickly capacity turns into revenue.
Short reaction. Not what anyone expected.
Yeah, that tracks.
Switching gears. The iShares Silver Trust plunged, down 4.8% to $66.37 on about 81 million shares traded. That was a heavy session.
That was forceful. A near 5% one-day drop on that kind of volume can trigger stop losses, forced selling, and margin squeezes in related products. It also speaks to coordinated flows. Could be large block liquidation, option hedging, or retail coordination.
Walk me through why ETF-level moves like that ripple so widely.
Sure, ETFs are often held by other funds, leveraged products, and by retail investors directly. When an ETF falls sharply, funds might need to rebalance, brokers may get margin calls, and market makers could face hedging pressures. That pushes price moves into miners, royalty companies, and futures, a cross-asset effect.
So the watch list is continued volume in the silver ETF, price action in silver futures, and comments from big market makers about redemptions?
Yep. Also watch whether flows spread to other metal ETFs. That would suggest a broader risk-on, risk-off shift rather than a silver-specific event.
Short reaction. Big move. Our third headline was a tech story that could be quietly important. Landgate launched an engineering-grade battery storage analysis tool on February 18th, aimed at standardizing and speeding due diligence for storage projects. Drew, why does that matter for developers and lenders?
In plain terms, underwriting and due diligence can be slow and manual. If you standardize the technical checks and automate the analysis, you can shorten loan approval cycles and get projects financed faster. Faster underwriting can translate into faster deployments and tighter margins for developers. That affects profitability and project economics.
So this could be a catalyst for companies with big storage pipelines?
Definitely. If developers or utilities publicly reference faster underwriting or pilot wins, that could be a near-term catalyst for names with large storage footprints. Watch earnings calls from big players in storage and renewables for mentions.
And to add to that, faster underwriting could reduce contingency buffers and change reported margins on projects. Small change in timelines can be a big change for returns.
Right. It's an infrastructure-first phase, incremental tech that improves unit economics, not a boom overnight. Think steady improvement.
Let's thread these three stories together. Big corporate capex, retail-driven volatility, and tech that speeds deployment. What's the pattern you see?
Three themes. 1. Companies are allocating capital into specialized manufacturing and infrastructure, like the Johnson & Johnson site, and hydrogen compressor markets. 2. Data and automation are starting to compress project timelines. Landgate is an example. 3. Governance and trust issues remain a risk, especially in fintech and small caps, which can amplify volatility when flows move quickly.
Speaking of governance, the briefs flagged faster AI rollouts at brokerages with governance lagging, and a point-of-sale financing partnership between Sheffield Financial, that's a Truist Bank unit, and Mercury Marine. Thoughts on the fintech angle?
The core problem is speed versus controls. Brokerages are adding consumer-facing AI quickly, but accuracy and governance frameworks aren't catching up. That's a regulatory and reputational risk. Meanwhile, embedded finance, like point-of-sale loans for boat packages, can boost unit sales, but it changes credit mix and introduces seasonality into loan books.
So investors should watch disclosures on governance frameworks and loan performance metrics?
Exactly. Watch for governance frameworks, accuracy metrics for AI tools, and any early performance numbers on point-of-sale originations.
Quick aside, there was also a note that the hydrogen compressors market could reach about $2.6 billion by 2028, with roughly a 4.5% compound annual growth rate from 2023. That sounds like steady demand rather than a boom.
Yes, a long-duration infrastructure play. That favors established industrials and equipment suppliers with proven pipelines, not speculative small names.
We also saw some legal and analyst noise. A potential securities fraud class action notification for Rictech Robotics, and a mixed analyst note on Camtech, where the rating dropped but the price target went up. That's confusing.
Honestly, I was a bit surprised by that Camtech note. A lower rating paired with a higher target signals mixed conviction from the analyst, could create short-term volatility while investors reconcile it. And the class action notice is classic small cap risk. Legal fees, settlement potential, and management distraction.
Short reaction, watch legal filings.
Right. Look for court docket entries and motions that clarify timelines and alleged damages.
Let's hit the quickfire scan, our rapid checklist from today's briefs. Say each one and why it matters in a sentence or two.
Johnson & Johnson, over $1 billion into a cell therapy site in Pennsylvania. Watch timelines and any contract manufacturing announcements. iShares Silver Trust, down 4.8% to $66.37 on heavy volume. Watch follow-through in volumes and silver futures. Landgate, launched a battery storage analysis tool. Watch for early adopters and earnings call mentions from developers. Hydrogen compressors, market to about $2.6 billion by 2028. Long-duration industrial opportunity. Corporate insight, brokerages rolling out consumer AI with governance gaps. Regulatory and reputational flag. Rictech Robotics, securities fraud class action notice. Legal risk for small cap holders. Camtech, analyst downgrade with higher price target. Mixed signals, verify identifiers before acting. Lubricant additives, rising demand for higher performance products, favors specialty formulators. Sheffield Financial and Mercury Marine, point-of-sale financing could boost retail sales and dealer conversions. Career and technical education, rising demand, watch vendor contract flows and state budgets.
That's a helpful checklist. For listeners who want to act on any of these, what are the practical steps you'd recommend?
First, for Capex stories like Johnson & Johnson, track operational timelines and any filings that show project spend schedules. Second, for ETF or flow-driven moves like the silver sell-off, monitor volume, futures, and correlated equities for confirmation before making directional bets. Third, for tech adoption stories, listen to developer and utility earnings for pilot wins or adoption language. Finally, for fintech and small-cap governance flags, prioritize transparency and conservative sizing until governance details improve.
Great. Before we wrap, Anything you'd call out as the single most important thing to watch tomorrow?
Follow through in silver volume and price action is the immediate market event to watch. It can cascade quickly. Operationally, watch any Johnson & Johnson updates on timelines or partnerships, and keep an ear out for developers mentioning faster underwriting from tools like Landgate.
Final takeaways?
1. Big capital deployment into specialized manufacturing is real and will shift industry supply dynamics. 2. Data and automation are quietly changing project finance and deployment speed. That's structural. 3. Governance and flow risk are active. Retail or institutional flows can produce fast moves, and governance gaps can create regulatory surprises. Stay nimble on liquidity and watch for confirmatory follow-through on the 3 big stories.
Perfect. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly, and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks, Drew. Always great to break this down with you. And thanks to everyone listening. We'll be back after the next close.
Thanks. Talk soon. Take care.